Hi, I'm Kevin French from Core Wealth. It's the end of the first quarter that we are covering today, and we'll talk a bit about March, and then we'll spend a fair bit of time looking forward, just given all the noise and volatility that are in financial markets around the world at the moment. Tariffs, that's what's getting the whole world nervous at the moment. Not because there's tariffs there, but because they keep changing. And markets don't like uncertainty, and so we've seen volatility around the world, which is actually something that's measured in many markets, spiking up at the moment. And so we're seeing some really big days, markets going up, and really sharp down days, and we'll talk a little bit more about that later on. So March was a weak month for global developed markets, particularly the US, and we've seen the US, because it had high valuations on their stock markets, coming down quite a bit so far in the first quarter. We've also seen in the month of March European markets being a fair bit softer, and Japan also being down. So developed markets around the world have come off, the US in particular, and one of the things that has caused this, in the US anyway, has been the concern that we could see a recession there at the end of the year because of the tariffs coming in and slowing that economy down. The second biggest economy in the world is China, and we've seen that starting to improve somewhat over the last couple of months and the last year, in fact. And we've seen, as China has been trying to stimulate their economy, we've seen that improving, and we've seen manufacturing in China improve over the last 2 months, now the highest level in the last year. And we've also seen the services sector starting to improve as well. Again, some tailwinds for the Chinese economy, and their stock market has actually rallied a little bit on the back of that. With all the political uncertainty or geopolitical uncertainty in the world, think Israel-Palestine, think Russia and Ukraine. The latest one is between the US and Iran. All of these things create concern, and then gold is often seen as a store of value. And we've seen this in the gold price reaching an all-time high of $3,145 an ounce. Because of that, gold mining companies have done very well, and we've seen that in the South African Stock Exchange, where the gold index has gone up, or the gold mining index has gone up. We've also seen an improvement in some of the other precious metals prices, palladium, platinum, also going up, and that has pushed up the South African stock market. So at the end of March, just up over 5% for year to date, and that has been beneficial for investors in the SA market. So these are the global market performances year to date to the end of March 2025. The developed markets, measured by the MSCI World at the top of this table, for the month of March down 4.5%, and which means year to date, if you invested in developed market equities, it was actually negative over that 3-month period. Emerging markets were positive, and so we're seeing now over the last year, actually emerging markets have outperformed the developed markets. And this is something we've spoken about in the past, that particularly the US equity market was quite expensive. So year to date, US equities down just over 4%, Japanese equities similar levels, just over 5%, but European and UK equities both up quite nicely over the last 3 months. Chinese equities slightly negative, but if you look at that over the last year, you can see that China and the UK were really good places to have been invested over the last year. These are the performances of the South African financial markets up to the end of March 2025. Okay, big stories. March was really positive for the South African equity market, and year to date looking quite nice. In the first quarter up 5.9%. Listed property off somewhat, but you can see over the longer term, over the last year, almost up 20% over the last year. South African bonds relatively quiet so far year to date, but again over the last year up over 20%. And then in the month of March, we could see that the rand strengthened against the dollar by just 1%, and so far year to date is 2.5% stronger against the dollar to the end of March. The interesting point for me is probably looking at the 5-year numbers. The last 3 years includes 2022, which was one of the worst years globally for both bond and equity markets. But if you look through that and you look over the last 5 years, which really takes us back to COVID, you can see that investors' wealth has really grown. Equity markets up over 19% a year. The listed property similarly, bonds giving you almost 12%, and inflation through that time was only sitting at just under 5%. So really healthy real growth, in other words ahead of inflation, over that last 5-year period. So we're going to have a look at the Core Wealth global strategies, two sets of them, one denominated in US dollars and one denominated in British pounds. So let's start with our global strategies, the ones denominated in pounds. These are our latest strategies, so heading towards a 4-year track record now. You can see most of them, the green meaning that we've outperformed the class average, so ahead of the class average. And our balance strategy is slightly underperforming in the last year, but over the longer term, and these are all long-term strategies, we can see some nice outperformance of the class averages. So if we look at our global strategies that are US dollar denominated, these strategies now have been running since 2016, so heading towards a 9-year track record this year. And we can see some consistent outperformance of the peer groups, which is really pleasing to see. And again, some really decent returns over those longer time horizons. Our growth strategy over the last 5 years giving you 11% per year in US dollar terms. And so really good real return growth for investors in these strategies. Here we'll have a look at Core Wealth's South African models for South African investors in the different risk profile categories. Here are the different models that Core Wealth runs for South African investors, some of them in their 13th year now, so some really nice long-term track records. And we can see in the last 5 years, over both 1, 3 and 5 years, some really good outperformance in terms of the size of that outperformance of the peer groups, and the absolute returns now starting to get at really decent levels. If you think of inflation at just below 5% and you look at the last 5 years, our more aggressive strategies that are aimed at generating more growth, some of them in excess of 11% ahead of inflation. So that really generates good growth for clients over the longer term. But most pleasing for us probably is now seeing the 10 and the 12 and 13-year track records starting to nudge into double digits after those really tough years during the Zuma years where markets went sideways. So tariffs are a key driver of what's happening in markets at the moment. A difficult point of them is that they keep changing. And so we're just going to try and pull out some nuggets and truths that we think are important because they're influencing both economies and markets into the future. Liberation Day was the day that Donald Trump announced sweeping tariffs across all imports into America. And this slide that we're showing you now just shows firstly the purple line being the tariffs that are charged on US exports to these different countries mentioned here, and the gray line is the new tariff that Donald Trump announced for those countries' exports to the USA. And really this was in addition to the baseline 10% tariff on any import into the US, as well as a 25% tariff on automobiles, steel and aluminium. The concern that we're going to unpack now is what impact will this have on both the global economy and global trade. So what will these trade tariffs do to inflation? That's the big concern. And this graph just shows you the inflation, two different measures of it in the US, and how it's come down of late, but still higher than it used to be prior to the COVID. And we can see that at the moment it's between sort of 2 and 3%. The Fed would ideally like it below 2%, but the risk with these tariffs is that it actually moves up rather than down. And in 2025, a lot of economists are expecting that it could go to between 3 and 4%, possibly even higher depending where things land. And that is a concern that makes the consumer less optimistic, and on the back of that, the economy could slow down in the US and the risk of recession increases. So a 25% tariff on automobiles and parts feeds through into the economy in a number of ways. Obviously on purchases of new vehicles that are imported, but it also affects not only the spare parts. We've seen an increase already starting to come through in second-hand vehicles, and as well as on insurance for vehicles, because they have to insure against these higher costs coming in if a car is in an accident. And these concerns are creating uncertainty around what that knock-on effect will be to the economy, that the economy potentially slows down because of these increased costs coming through and because inflation is higher. Having a look at this slide, it just unpacks the different levels of revenue that will be generated depending where tariffs land. Now, bear in mind that the Trump administration is trying to generate additional revenue to get the country's balance sheet back in order. And if they're aiming for around $1 trillion of additional revenue, they're also looking at trying to cut costs. That's what DOGE is all about. Then they start impacting the balance sheet meaningfully for the longer term. And you can see at around 10% level, that's what this graph shows, the bottom line, there's an additional revenue of between $300 and $400 million that could be expected. The higher that tariff goes, the higher the additional revenue would be, but there could be an impact on slowing down of economic activity, which would be a negative potentially in the whole picture. So artificial intelligence is something that has driven markets around the world, and they've had a big impact on some of the Magnificent Seven, as they've been called in the US. We've had a concern that parts of the US market are very expensive, and we've been underweight those areas. But what has happened, in January, we saw the launch of something called DeepSeek, which was an artificial intelligence model that was launched out of China that didn't need these high-powered computer chips to run, which things like ChatGPT do. And so that's impacted the future outlook of some of these large cap companies, the Magnificent Sevens. And these two graphs just show you how their earnings have been revised downwards, not to losses, but not as lofty as they were previously, the future earnings expectations. And we've also seen how the US tech sector has come under a lot of pressure since the launch of DeepSeek, and the Chinese tech sector has actually improved. And this just demonstrates that, markets are sensitive to the cost of production for different companies, and tariffs will feed into that as well around the world. For those who live in South Africa and are exposed to this economy, the big question is, well, how are these tariffs going to affect us? They've started out with a 30% proposed tariff, and this graph just shows you how our exports to America, which only make up just under 7.5% of our total exports, how are they broken up? And you can see that we mentioned earlier that the iron and aluminium and automotives were going to get the 25% tariff anyway. They do make up just on 20% of our total exports, but the biggest portion of our exports actually is by way of precious metals and stones. And you can see that makes up some 57% of our exports. In total, that amounts to around 65 billion rand, but 76% of that, so about 50 billion of the 65 billion, are not impacted by any tariffs at all. So there are areas where there are going to be challenges. The automotive industry, iron and steel, and aluminium, but that will have to be negotiated. However, the bulk of our exports to the US are not actually influenced by this, and so it's not all doom and gloom. And bear in mind that exports to the US only make up less than 7.5% of our total exports. Thanks for taking the time to watch this. If you've got any questions, either leave them below in the comments or get hold of your financial advisor, and we'd love to talk you through any questions you may have.